The thing that you have to do before you talk about what is happening now, I think it's probably useful to go back, and you have to really start at the end of the great financial crisis. And the reason is there was a bunch of people coming out of the GFC who confused what the US government and some European governments were doing. At the time, there was the risk of a huge financial contagion. And so the US stepped in and the Federal Reserve started to use their balance sheet to buy toxic assets. And the ECB did that, and I think Japan did that as well. Anyways, a bunch of governments did it. And then there was this body of pseudoscientific economists who coined this thing called modern monetary theory, which basically said, hey, you can keep printing money and introducing it into the economy to smooth things out and to actually drive long-term growth. And it turns out that a bunch of government officials fell for it. And if you fast forward to 2022, so 14 years later, governments around the world had printed something to the tune of about 35 odd trillion dollars of money into the economy that should have never been there. So the thing to remember is, like, we have not necessarily just been obfuscating true supply demand in the last 6 or 8 months when we've been talking about a recession or inflation. We've been actually doing it since 2008. It's just that it's been building up in the system. So one of the things that we have to realize is that all of that money somehow needs to get destroyed in some way, shape, or form if the true economic equilibrium is meant to be found. What is true supply? What is true demand in the absence of government sloshing money around, trying to prop up things that should not be propped up, or buying votes, or all the grifts that these folks have engaged in the last decade and a half have to get undone. So that's the backdrop. So if you think about taking $30 trillion out of the global economy, you're talking about almost, I think it's 85 trillion is the world GDP. So it's almost half of an entire year's worth of global GDP. It's going to take 3 years probably of the slow, meticulous, running off of money, not reintroducing new money. So it seems like we're at the beginning of something that's going to be long and drawn out. And that's separate from whether we're in a recession or not. That's just the bear market that we're in. Right? And so you have to look at asset prices today as a microcosm of a much larger trend that has to be about fake money pushing asset prices up, and now taking all that fake money out and finding out what the real price of something is. And I just don't think that takes 6 months. So for all the people that were, fingers crossed, hoping that this would be the end of it, Fed raises 75, we're done with this, they're going to raise 75 more. I just think that's not how it's probably going to be. It's going to take, 24, 36 months. That may mean the bottom doesn't happen for another 18 months. So I think we're in for a lot of choppy market action. We may not be negotiating against Russia, but we're enabling them to print enormous surpluses. Meaning, I don't know if you guys saw, but there was an article today. Janet Yellen is traveling around basically convincing folks to not include Russian oil from a bunch of import bans so that these Russian oil tankers can be insured. Why? So that they can sell this oil to places like China and India, etc.
The ruble's at a 5-year high.
We push for all these sanctions. Europe gets on board and says, we're going to do it and we're going to take the lumps. And then we go around Europe and basically say, well, we kind of want to fight this proxy war, but at the same time, we want to try to fix inflation, and we didn't mean to cause this. And it's completely disorganized what's happening.
Okay.
Look, here's the thing. I think we have to also be sensitive to the fact that the Fed operates on a certain class of data. And that data in the 21st century is pretty pathetic. There was an article, I think it was in the New York Times, that really walked through how CPI is calculated. And it's a bunch of people that work for the government that walk around with iPads, building relationships with local businesses in all these random places all around the country, and asking them to, chit chat for 15 minutes and do these surveys. Now, you would have thought that in 2023 or 2022, what the government would have said to Visa, MasterCard, American Express, all the payment rails, the banks, and Stripe is, send me a feed in the following structured way so that I can actually have an absolute precise sense of inflation, because inflation really only occurs when a good or a service trades hands for money, right? And you calculate what did that thing trade at the day before and what does it trade for today. So you could get an absolute precise sense of it. Instead, we do this random sampling thing. If you read this article, your takeaway will be, oh my God, this is very rickety, and it drives an enormous hammer that we use to try to manage the economy. That's the first thing.
Do you find yourself with a substantial amount of cash that's currently idle and not generating returns? It's high time you explore the trading app I've recently started using, Moomoo. It now offers an impressive 5.1% APY, plus an extra 3% APY for your uninvested cash. You have to know that 8.1% APY is 17 times the national average savings account interest rate, and there's no minimum deposit limit for cash sweeps. This is one of the highest interest rates I know of. Why I love Moomoo is it stands out by offering zero commissions and no platform fees for stocks, options, and ETFs. It's packed with powerful market analysis features for absolutely free. For example, now is the U.S. stock market earnings season. Financial data, analyst ratings, earnings calendar, and more are all free to use. The 6.8% margin rate is one of the lowest I've come across. You can tap into pro-level tools and information absolutely free. Sign up using my link below and grab up to 15 free stocks and park your idle funds on Moomoo for a sweet 5.1% APY plus 3% APY extra. Or earn up to $5,000 in cash rewards when you transfer assets to Moomoo.
I think you need to buckle your seatbelt because the next 3, 4, 5 months of CPI will probably be very, very bad. 7, 8, 9%. Why? There are a handful of components that have gotten completely run away. Number one, the biggest one is rent. And so rent works on a 3-month lag. We're going to reintroduce what the true owner's equivalent rent is into CPI. So we can already forecast that CPI going up. Russia is basically trying to break the back of Europe by now messing with their nat gas supplies. The German energy minister yesterday said that if that happens, it could be a contagion equivalent to Lehman Brothers with respect to energy. When you play all of these things out, what you have is unfortunately rampant runaway costs that really have no mechanism to get back in check in the absence of some real governmental changes. Our policy on this Ukraine-Russia war, how we intend to sort of work or cooperate or fight with China, all of these things have to get solved. So in the absence of that, prices are going to continue to go up. And so what does the Fed do? How does it throw away what little credibility it has left when there's 8 and 9% inflation prints and saying, we think we're done for right now? You can't do that. So they will overcorrect because there's just going to be so much pressure for them to act. All roads, I think, lead to lower equity prices. We've seen the first wave, but now it has to touch all these other areas. For example, we have gotten totally drunk on debt as a country. One of the most obvious places where we've been serving alcohol far too late into the night is in the financing of all these private equity leverage buyouts. These are sketchy companies that are sort of like teetering on insolvency at times, where private equity comes in, levers up the balance sheet with debt. They price it right to the edge of what's legally allowed or what's financeable, and then they go do it. But that's all assuming the economy continues to grow. And so if all of a sudden you have some recessionary forces or prices go up and earnings don't, you'll have a contagion in the debt markets. You could have a contagion in the commodity market. So we're dealing with some really tough boundary conditions. I do think that we can know these things without sampling in such a porous way. And now, we're going to, look, we've had a system of overcorrecting and undercorrecting for years. The problem is the stakes get higher and higher as the economy grows and becomes more complicated and intertwined.
And we have more leverage.
I also want to tell you guys a quick story. One of the most interesting canaries in the coal mine of all of this was 2 days ago and what happened to Facebook. And this sort of ties a lot of this stuff together in terms of economics, inflation, asset prices, equities. Everybody was saying, oh gosh, the market's going to rip on the open. And then on Tuesday, the market, the S&P was up like 250 basis points, 2.5%. And the NASDAQ was also up, call it maybe 300 basis points, roughly. But Facebook was down like 400 points, right? So it's a big spread. And why is that? And I was like, this makes no sense to me. What is going on with this price action? Everything was up. Apple was up. Google was up. And so I called around and, I was like, why is this happening? And this is the best explanation I got. When you look at who the incremental buyer is in the stock market, it tends to give you a sense of whether prices can go up or will continue to go down. And the poorest informed buyer tends to be retail. And the most informed buyer tends to be these very large institutional hedge funds, right? So there's a spectrum. And Facebook is an example of big tech that is poorly owned by retail. So it's mostly owned by smart money. And the case that smart money makes for owning Facebook is that it's got an extremely cheap price to earnings ratio. So you must own it. And what they said was that looking at the tea leaves of consumer demand, what they actually re-underwrote was that actually it's not that the price to earnings was cheap, it's that the E in PE was just wrong. And if they pass through all of these increases in inflation and, their earnings expectations into Facebook, it's actually more like fair value at a lower price. That's why they sold it so much on a day where the market was up. Now, why is that important? Well, eventually you're going to touch all these other stocks as well that are going to go through earnings revisions in this recession. This is where I think Wall Street has done a very poor job on behalf of retail. If you look at the average estimates of earnings you will be shocked to hear that Wall Street actually has this year being record earnings, next year earnings continuing to go up. How is that even possible? How do you see earnings continuing to go up into these prints like this when you cannot pass through 80, 90% increases in energy and COGS and whatnot? You have to sell fewer things because there'll be fewer people with jobs to buy things. I think Wall Street's wrong. And I think that earnings are going to go down this year and will definitely go down in 23. And so I think what probably happens is the entire world of equities needs to get repriced at a lower price. And in that, it's going to put enormous pressure on these cash-burning, non-profitable tech companies. Part of the government acknowledges that you have to really ring fence and protect consumers. If you look at the securities laws, they're meant to protect them at all costs. But the reason is because sometimes you want people to make good decisions, and if you give them a bunch of firepower, they're just going to spend it. And what we really did was we gave folks just a ton of money. And what did they do? They acted rationally. They spent it. Now we have to take it all back. I don't think that's going to be as easy or as simple as people think. It's stunning that, the reason the stock market went up, dollar for dollar, was actually tied to the growth in the M2 money supply. The correlation was 0.92. So for every dollar that the Fed printed, the stock market went up by 92 cents. So it stands to reason that if the Fed is going to take $3 to $5 trillion of value out, then we have to re-rate the equity markets by $3 to $5 trillion at a minimum. And then you have to re-rate and re-baseline for earnings. And so that's probably another 20 or 30%. You're assuming that all of a sudden demand is stable, but it's not necessarily stable. In a demand contraction, yes, people get fired, but then also new job openings change. There's fewer of them. They're more specific. Again, we're at the beginning of the beginning. For all of us that lived through 2000, this was 4 years of sheer hell and a grind. Now we have $30 trillion that we have to work through the economy, a recession we have to overcome, a war we need to end, and people all of a sudden assume that 2 or 3 rate hikes and 5 or 6 months of headlines are enough. And on the margin, maybe they're right. But from my perspective, it's an observation that we're at the beginning of something that just fundamentally has to take some amount of time to work its way through the system. And so I don't understand why anybody would give up their liquidity in this moment right now. Why would you? Why would I give up $100 million of cash in my bank account? I would not do that right now.
The people in Russia are suffering during this. The people in Ukraine are being murdered. I mean, how does it end?
The problem is that Biden engaged the United States in a proxy war without our real explicit discussion, number one. And then number two is then we pulled and we pressured Europe to really draw a hard line, but then now are kind of working around it so that the countries that suffer the most are Europe. Now, I think you're starting to see the tea leaves, though. Last week, there was a group of European leaders, I think it was Macron, Draghi, and one other person, who went to Ukraine. And if I had to bet, I think the message was we need to find an organized detente here because there is, according to Europe, a Lehman-like situation in terms of economic contagion that could manifest over the next months. So I think that the end game is probably some organized, negotiated detente and ceasefire. I don't think anybody will be happy with it, but I think by and large, Russia is and has won, meaning they've won economically. They're selling oil like it's not going out of style. It's just not selling it to Europe and to America. They're selling it to China. They're selling it to Africa. They're selling it to India. We engage in economic sanctions, and I was the first one to say, hey, this could really work, and this could be a roadmap for how to do it. And it turned out this is the roadmap for how not to do it. You can't, on the front door, say, here are these sanctions, and then walk around the back door and basically open the door for them. These sanctions were so porous as to be like Swiss cheese. We focused on virtue signaling acts, confiscating a plane or a boat or a house, but we didn't focus on the structural things we needed to actually make the mandate that we believe to be just to come to life. And so Russia's completely worked around it. Their economy effectively is thriving. So what have we gained? It was the exact opposite of what we tried to do. Russia's current account surplus more than tripled in the first 4 months of the year. Prices surged for its oil and gas imports, and imports plunged under the weight of sanctions. Well, if you're Putin and you're looking at this, you're like, wow, maybe I should be under sanctions more often. What country should I invade next? So not only did our sanctions package not work, and not only is the Treasury flailing around now trying to find even more backdoors, we actually opened a very dangerous precedent, which is now we allowed oil to settle in currencies that are not just the United States dollar. And now Russia and China are trading and settling in CNY. That's not good for us. This is not how you preserve the reserve currency of America. If you have a country that has existed in some way, shape, or form, the borders could be blurry, but roughly, for hundreds and hundreds of years, and in some cases, thousands of years, where internally, the population of that country views themselves, in a great way. They don't feel like their country is a meaningless nothing country. Any attempt to economically humiliate such a country tends to have failed in the past and will continue to fail. And there tends to be other countries who view it as one of these things where, well, if them, then why not us? And then they sort of, in a backhanded way, support everybody. So we end up in this odd situation where we are picking fights we cannot win. And the consequences for us are economically really damaging. And then the consequences for everybody else to stay on the sidelines is like economic prosperity. That doesn't make any sense.
Sign up using my link below and grab up to 15 free stocks and park your idle funds on Moomoo for a sweet 5.1% APY plus 3% APY extra. Or earn up to $5,000 in cash rewards when you transfer assets to Moomoo. Assets to Moomoo. Assets to...
You mentioned we're in a big bubble. Can you elaborate on that, and how is this likely to play out?
When you print money on the scale that modern nations are printing it, Japan, the United States, Europe, etc., we're getting into new territory in terms of size. There's never been anything quite like what we're doing now, and we do know from what's happened in other nations, if you try and print too much money, it eventually causes terrible trouble. And we are closer to terrible trouble than we've been in the past, but it may still be a long way off. I certainly hope so. When Volcker, after the 70s, took the prime rate to 20% and the government was paying 15% on its government bonds, that was a horrible recession. Lasted a long time, caused a lot of agony. I certainly hope we're not going there again. I think the conditions that allowed Volcker to do that without an interference from the politicians were very unusual. And I think in 2020 hindsight, it was a good thing that he did it. I would not predict that our modern politicians will be as willing to permit a new Volcker to get that tough with the economy and bring on that kind of a recession. So I think the new troubles are likely to be different from the old troubles. You may wish you had a Volcker-style recession instead of what you're going to get. The troubles that come to us could be worse than what Volcker was dealing with and harder to fix. Think of all the Latin American countries that print too much money. They get strongmen and so forth. That's what Plato said happened in the early Greek city-state democracies. One person, one vote, a lot of equality, and you get demagogues, and the demagogues lather up the population, and pretty soon you don't have your democracy anymore. I don't think that was a crazy idea on Plato's part. I think that accurately described what happened in Greece way back then, and it's happened again and again and again in Latin America. We don't want to go there. At least I don't. We've done something pretty extreme, and we don't know how bad the troubles will be, whether we're going to be like Japan or something a lot worse. And what makes life interesting is we don't know how it's going to work out. I think we do know we're flirting with serious trouble. I think we also know that some of our earlier fears were overblown. Japan is still existing as a civilized nation, in spite of unbelievable excess by all former standards in terms of money printing. Think of how seductive it is. You have a bunch of interest-bearing debts, and you pay them off with checking accounts, which you're no longer paying interest. Think of how seductive that is for a bunch of legislators. You get rid of the interest payments, and the money supply goes up. It seems like heaven. And, of course, when things get that seductive, they're likely to be overused. If you stop to think about it, my way in life was not predicting little short-term differences between the Russell index and the Standard & Poor's index. I don't have any opinion about which index is better at any given time. I never even think about it. I'm always just looking for something that's good enough to put Munger money in. And I figure that I want to swim as well as I can against the tides. I'm not trying to predict the tides. If you're going to invest in stocks for the long term or real estate, of course there are going to be periods when there's a lot of agony and other periods when there's a boom. And I think you just have to learn to live through them. And as Kipling said, treat those two imposters just the same. You have to deal with daylight and night. Does that bother you very much? No. Sometimes it's night and sometimes it's daylight. Sometimes it's a boom, sometimes it's a bust. I believe in doing as well as you can and keep going as long as they let you.
Have questions about your financial situation? Get a second opinion on Money Pickle. In less than 5 minutes, you can book a 45-minute video chat with a vetted and trusted CFP, fiduciary, or hybrid advisor. They'll tell you exactly what they'd do in your shoes. Ease your mind on retirement, estate planning, 401ks, taxes, inheritances, whatever's stressing you out. Best of all, it's free. You can even start a relationship with your professional, but there's no obligation and no commitment. Money Pickle, your free financial help desk. Book your free session on moneypickle.com today.
What impact has passive investing had on stock valuations?
Oh, huge. That's another thing that's coming. We have a new bunch of emperors, and they're the people who vote the shares in the index funds. Maybe we can make Larry Fink and the people at Vanguard Pope. All of a sudden, we've had this enormous transfer of voting power to these passive index funds. That is going to change the world. And I don't know what the consequences are going to be, but I predict it will not be good. We have a hugely strong economy and a hugely strong technical civilization, and that's not going away. And the knowledge and so forth. And you can't believe what a modern factory looks like when you fill it with robots. And that's coming more and more and more. And it's coming to China too, for that matter. And so those trends are inevitable. And I think it does create adjustment problems. If you have a fine unionized job and they replace you with a robot, you've got a difficult problem. And if you've got a company like Kodak and they invent something new that obsoletes your product, you have a problem too, and you solve that by dying. A lot of people don't like that solution. Because all those problems are real, and because it's so tempting to get rid of your debt by just giving a guy a non-interest-bearing checking account where you used to have to pay him interest every month, not only do we have a serious problem, but the solution to it that is the easiest for the politicians and for the Federal Reserve too, for that matter, is just to print more money and solve the temporary problems that way. And that, of course, is going to have some long-term dangers. And we know what happened in Germany when the Weimar Republic just kept printing money. The whole thing blew up, and that was a contributor to the rise of Hitler. So all this stuff is dangerous and serious, and we don't want to have a bunch of politicians just doing whatever is easy on the theory that it didn't hurt us last time, so we can double it and do it one more time, and then we double it again and so forth. We know what happens on that everlasting doubling. You will have a very different government if you keep doing that enough. You're flirting with danger somewhere, unless there's some discipline in the process. But I don't regard Japan as in some terrible danger. They've done a huge amount of this and gotten by with it. I don't think we'll be as good at handling our problems as Japan is.
If taxes were not an issue, what are your thoughts on going to cash today and waiting for better opportunities to deploy that cash over the next 12 months? Is it a sensible idea in your mind?
In my whole adult life, I've never hoarded cash waiting for better conditions. I've just invested in the best thing I could find, and I don't think I'm going to change now. And the Daily Journal's used up its cash. Now, Berkshire has excess cash, quite a bit of excess cash. But it's not doing that because it thinks it knows how to time investments. It just can't find anything it can stand buying. So we don't have a solution to your problem. We're just coping with it as I've described.
Given the valuation and market correction in early 2020, why is Berkshire not picking up or adding any new companies to its profile? Of course, kudos to the team in picking up Apple shares a couple of years back. That's paying off for sure.
The reason we're not buying this, we can't buy anything at prices we're willing to pay. It's just that simple. Other people are bidding the price up. And a lot of the buying is not by people who really plan to own them. A lot of it is fee-driven buying. Private equity buys things so they can have more fees by having more things under management. Of course, it's a lot easier to buy something you use somebody else's money. We're using our own money, or at least that's the way we think of it. I've always believed that nothing was worth an infinite price. Even an admirable place like Costco could get to a price where you would say that's too high. But I would argue that if I were investing money for some sovereign wealth fund or some pension fund, and a 30, 40, 50-year time horizon, I would buy Costco at the current price. I think it's that strong an enterprise and that admirable a place. By the way, it's not a tragedy that Berkshire has some surplus money they're not investing. We look more responsible with the extra wealth, and we are more responsible with the extra wealth. The shareholders who are worried about the future because it looks complicated and difficult and they're hazard, I want to say to them what my old torts professor said to me, Charlie. He'd say, Charlie, tell me what your problem is and I'll try and make it more difficult for you. And he did me a favor by treating me that way. And I'm just repeating his favor to you. when you're thinking the thoughts you're doing, at least you're thinking in the right direction. You're worried about the right things. All you people that are worried about the inflation and the future of the republic and so forth. Inflation is a very serious subject. You can argue it's the way democracies die. When democracy dies in Latin America, inflation is a big part of it. So it's a huge danger once you've got a populace that learns it can vote itself money. If you overdo it too much, you ruin your civilization a lot. But of course, it's a big, long-range danger. If you look at the Roman Republic, even after they went to an empire with an absolute ruler, they inflated the currency steadily for hundreds of years, and eventually the whole damn Roman Empire collapsed. So it's the biggest long-range danger we have, probably, apart from nuclear war. I think the safe assumption for an investor is that over the next 100 years, the currency is going to zero. That's my working hypothesis. A very dangerous environment. What brought in Hitler was the combination of the Weimar inflation, where they utterly destroyed the savings of the middle class in Germany, followed by the Great Depression. It was a 1-2 punch. And Hitler came in, crazy demagogue, with 40% of the votes, and pretty soon we had a dictator hell-bent for world war. So the history is not pleasant. And Germany was a very advanced and civilized nation, the Germany that Hitler took over. I always say that the interesting thing about that was little Albert Einstein, a little Jewish boy, got his entire primary education with the insistence of the Catholic Church in Germany. Now that is a very civilized nation. So if you let your nation deteriorate too much, what you get is a Hitler. We proved it. Of course, in a modern democracy in the age of Keynes, you're going to get big government reaction. The reaction this time was bigger than it's ever been before in the history of the United States. They just threw money at the problem. And they were probably right to fear what was going to happen and to be quite liberal in throwing money at it, but they probably overdid it a little. They threw so much money so fast that it's hard for the restaurants to get people to do the work. But I don't criticize it. It's hard to make these decisions under pressure. Well, you have to be optimistic about the competency of our technical civilization. But there again, it's an interesting thing. If you take the last 100 years, most of modernity came in that 100 years. And in the previous 100 years, that got another big chunk of modernity. And before that, things were pretty much the same for the previous thousands of years. Life was pretty brutal and short and limited and what have you. No printing press, no air conditioning, no modern medicine, no. I don't think we're going to get things that were in what I call the real human needs. Think of what it meant to get, say, first you got the steam engine, the steamship, the railroad, and a little bit of improvement in farming and a little bit of improvement in plumbing. That's what you got the 100 years that ended in 1922. The next 100 years gave us widely distributed electricity, modern medicine, the automobile, the airplane, the records, the movies, the air conditioning in the South. And think what a blessing it was. If you wanted 3 children, you had to have 6 because 3 died in infancy. That was our ancestors. Think of the agony of watching half your children die. It's amazing how much achievement there's been in civilization in these last 200 years, and most of it in the last 100 years. Now, the trouble with it is that the basic needs are pretty well filled. In the United States, the principal problem of the poor people is they're too fat. That is a very different place from what happened in the past. They were on the edge of starving. And what happens is, it's really interesting, is with all this enormous increase in living standards and freedom and diminishment of racial inequities and all the huge progress that has come, people are less happy about the state of affairs than they were when things were way tougher. And that has a very simple explanation. The world is not driven by greed, it's driven by envy. And the fact that everybody's 5 times better off than they used to be, they take it for granted. All they think about is somebody else has having more now, and it's not fair that he should have it and they don't. That's the reason that God came down and told Moses that you couldn't envy your neighbor's wife or even his donkey. I mean, even the old Jews were having trouble with envy. And so it's built into the nature of things. It's weird for somebody my age, because I was in the middle of the Great Depression when the hardship was unbelievable. I was safer walking around Omaha in the evening than I am in my own neighborhood in Los Angeles after all this great wealth and so forth. So, and I have no way of doing anything about it. I can't change the fact that a lot of people are very unhappy and feel very abused after everything's improved by about 600% because there's still somebody else who has more. Think of the pretentious expenditures of the rich. Who in the hell needs a Rolex watch so you can get mugged for it? Yet everybody wants to have a pretentious expenditure, and that helps drive demand in our modern capitalist society. My advice to the young people is don't go there. The hell with the pretentious expenditure. I don't think there's much happiness in it. But it does drive the civilization we actually have. It drives the dissatisfaction.
How will this all play out, and what's the best advice you have for individual investors to optimally deal with the negative impact of inflation other than owning quality equities?
Well, it may be that you have to choose the least bad of a bunch of options. That frequently happens in human decision making. And the Mungers have Berkshire stock, Costco stock, Chinese stocks through Lilu, a little bit of Daily Journal stock, and a bunch of apartment houses. Do I think that's perfect? No. Do I think it's okay? Yes. I think the great lesson from the Mungers is you don't need all this damn diversification. That's plenty of it. You're lucky if you've got 4 good assets. I think the finance professors sell the idea that perfect diversification is professional investment. If you're trying to do better than average, you're lucky if you have 4 things to buy. And to ask for 20 is really asking for egg in your beer. It's very few people have enough brains to get 20 good investments. It's going to be way harder for the group that's graduating from college now, for them to get rich and stay rich and so forth. It's going to be way harder for them than it was for my generation. Think what it costs to own a house in a desirable neighborhood in a city like Los Angeles. I think we'll probably end up with higher income taxes too and so on. No, I think the investment world is plenty hard, and I don't think in my lifetime, 98 years, it was the ideal time to own a diversified portfolio of common stocks that updated a little by adding the new ones that came in, like the Apples and the Alphabets and so forth. And I'd say the people got maybe 10 or 11% if you did that very intelligently before inflation, and maybe 9% after inflation. That was a marvelous return. No other generation in the history of the world ever got returns like that. And I don't think the future is going to give the guy graduating from college this year nearly that easy an investment opportunity. I think it's going to be way harder. Some people are gifted enough that they can invest in hard-to-value, difficult things. Other people, I think, would be very wise to have more modest ambitions in terms of what they choose to deal with. So I think you have to figure out your level of skill, or the level of skill your advisor has, and that should enter the equation. But to everyone who finds the current investment climate hard and difficult and somewhat confusing, I would say welcome to adult life.
Book your free session on moneypickle.com today.